Welcome to Rona's Academy, where all complications in all business related courses are made comprehensible via online means, where we establish the concepts and the principles that will aid you in passing all exams with an ease. So subscribe and become part of the learning family, where we learn together and explore Ronas, comprehending the complications. Every firm or every company deals with either goods or services. Those that specifically deals with goods either manufacture those goods and sell them to customers, or they buy the goods and then resell them. So they purchase the goods for resale. And those goods collectively known as inventories. How to account for them? The amounts to be presented on the statement of financial position of the entities have all been enshrined in International Accounting Standard 2, that is IAS 2 inventory. So today, our lesson is basically going to be on IAS 2. So IAS 2, that is what? Inventories. Now, let's look at the scope of inventories. When we say inventories, we know they are goods. But when we talk about biological goods, they have an accounting standard that have been devised for it, and agricultural goods. So it will probably not be captured under IAS 2, that is inventories. And then when we take financial assets as well, where we can find trade receivable, we can find trade payables. They are those goods that are being sold on credit and those goods that are being bought on credit. Because they have a standard device for them, we will not account for them under IAS 2, under inventory. So that is the scope, basically deals with a group of assets that has been enshrined in the definition of inventory. So when we say inventories, what do we mean? When we say inventories, according to the standard, we are basically looking at three categories of assets. So when we say inventories, we are saying that one, we are looking at finished goods. So these finished goods are goods that are traded in the ordinary course of what? The business. Remember, we are saying three categories of what? Assets. So three categories of assets. So the first one is that finished goods that are being traded in the ordinary course of the business. These are goods that entities go and purchase and then resell them. So these are finished goods. The next category of asset under inventories are work in progress. And these work in progress are those goods, in fact, some companies manufacture the inventories before they sell them. So if at the end of the period, those goods are still in the production process, so those partly complete goods are referred to as work in progress. And therefore, they are accounted for under inventories. So work in progress, goods that are partly completed, they are assets that fall under inventories. So the third category of inventories has to do with raw materials. Again, the entities that produces their own inventories and then sell them to their customers will require raw materials to produce those goods. Those raw materials that are needed for the production process, or that are used in the production process, are also form of assets. So basically, when we say inventories, we are looking at finished goods held in the ordinary course of the business, or finished goods that are held for resale purposes. We have work in progress that are assets or raw material that are partly completed, or goods inventories partly completed. And we also have raw materials that will be used in the production process. They all come together to form what we call inventory. So anytime we say inventories, let these three assets comes to mind. Now, when should we recognize an item of inventory? We should only recognize an item of inventory when they meet the definition of the definition as enshrined by the standard. So, and also enshrined in the regulatory framework. Knowing the definition of inventories and knowing what comprises inventories, let's look at how to measure inventories. Remember that inventory is supposed to be measured at the lower of cost and net realizable value. So we value inventory at the lower of 1, costs, 2, net realizable value. So we value our inventory, or we measure inventories at the lower of cost and net realizable value. What does it mean? It means that anytime we are presented with a practical question and you have information on how to get a net realizable value and you have information on how to get the cost of that particular inventories, you are supposed to look for them. Assuming the cost is giving you $100 and then the net realizable value, you have information to account or to calculate or compute it, and you are getting $110, then we are saying that what you present in the books of the entity as the cost of the inventory should be the lower of the two. In this case, we are going to choose the cost, which is what? 100 should be the cost that you present in the books of the entity. Now, what comprises the cost of inventory? So let's basically turn our attention from how to measure inventories now to how to account or how to compute for the cost. So our focus is on the cost. Now, according to the standard, we have three main group of what cost under inventories. The first one has to do with the purchase price. The purchase price. We also have the conversion cost. And we have the third one to be the other costs. Now let's take them one by one. The purchase price has to do with the amount the entity will pay to receive the goods. And we will take into consideration non-refundable tax. So if there is any non-refundable tax, we add. And if there is any refundable tax of that matter, what do? We are going to less, depending on the situation in the question. Sometimes the non-refundable tax is already embedded in the purchase price, therefore you don't do anything to it. But if it is a refundable tax and it is embedded in the purchase price, that is when we less. But if it is a separate item, if the refundable tax is a separate figure, separate value from the purchase price, we don't start it at all. So depending on the condition, in the question or the condition attached to the question and what you are supposed to do. We also take into consideration trade discount and then tax rebate. If any of them is present in the question, we have to take it from the purchase price. That is about the purchase price. The conversion cost has to do with, in case we are converting the raw materials or we are converting material from their raw state to finished goods, all those costs that are directly attributed to the conversion of that particular raw material should be taken into consideration. In this sense, we are looking at direct labor, we are looking at direct material and direct expenses and any overheads that are directly related to the construction or conversion of the raw materials. The other costs are all those costs that are directly attributable to bringing the inventory to their location and in their right condition. So all these come together and then we get the cost of our inventory. So these are the things or the items that come together or that comprises the cost of the inventory. Now let's look at the net realizable value. When we take the net realizable value, we are saying that, assuming this is our dollar sign, we are saying that it is an estimated selling price. Is that okay? An estimated selling price. That means we are looking at the estimated selling price, something that we are going to forecast or envisage. So an estimated selling price. So I'm using initials, estimated selling price assuming we have it here, and then we will less estimated cost to complete that particular inventory. So estimated cost to complete. So using initials again, so estimated cost to complete that particular inventory. Again, we are going to less it from the estimated selling price, and then we also again less estimated cost to sell. These are additional costs that an entity will incur when they are making the sale of the inventory. For example, carriage outward. All these come together to form the estimated cost to sell. And again, we are going to less it from our estimated selling price. So we are going to less our estimated cost to sell. Remember, this is cost to complete, and this is cost to sell. We are going to less this one from this. And the outcome is what we are going to call, or is what we refer to as our net realizable value. Net realizable value. So probably this information will be provided for you in any practical question situation. So you will get the estimated selling price, you also get the estimated cost to complete, and you also get the estimated cost to sell. Remember, they are the incremental costs that an entity will incur in making sale of the inventory. Therefore, if we take these two figures from the estimated cost to sell, probably you arrive at your net realizable value. So this is how you compute for your net realizable value, and this is how. And the previous one is the things you take into consideration when you are dealing with what the cost of the inventory. Now let's take a practical example and see how we can use them in our in case we are confronted with a practical question. Right, so assuming we are presented with this information on the board, and they are asked to determine the cost of the inventory that will be recognized in the books of the entity. So we have the purchase price being 250, we have the carried inward 10, the direct labor cost being 40, and then we have administrative expenses or cost being 15. We also have information on the net realizable value in a situation where the finished goods is not there. These are our estimated values. We estimate that the selling price of the inventory when finished producing it will be what, $320. You have the estimated cost to complete it will be $10, and we also have the estimated cost to sell will be $15. What amount will you present in the books of the entity? So first of all, let's look at the cost. So let's look at the cost. So the cost over here, remember it is in dollars. Always take the purchase price into consideration. Yes, you will take the purchase price because under IAS 2, the purchase price forms part of the cost of the inventory. It's supposed to be capitalized as part of the cost of the inventory. What about the carried inward? Of course, yes, because it's directly attributable to the inventory, bringing the inventory to the business location and in the good condition. So the then will also be captured. And then also direct labor cost. Remember the convention, we are looking at direct labor cost, direct expenses, and direct material cost. So the 40 will also be captured. What about the 15, which is administrative cost? Administrative cost is indirect cost, which cannot directly be attributable to the conversion of the inventory. Therefore, these $15 should immediately be expensed in the profit or loss account as an expense, but it shouldn't be capitalized as part of the cost of the inventory. So in this case, we are going to get that is $200 as the cost of the inventory. Now let's look at our net realizable value. We have been provided with figures. We know that still dealing with dollars, the estimated selling price is $320, and then the estimated cost to complete the item is 10. Remember, we are going to less this, and then the estimated cost to complete, that is the incremental cost in selling the assets, is going to be $15. We are lessing that as well. So if you less 10 from the get rate and you less this, you are going to get 295. So sorry, this is going to be a 300. Sorry, 300 and then 295. So in this case, at what value are we going to present against your inventory in the books of the entity. Probably remember that it is the lower of the cost and net realizable what value. In this case, our net realizable value is lower than what? The cost. So the cost of our inventory is going to be 295. Now, what happens to the difference between the cost and the net realizable value? Anytime you are dealing with inventories and then the value that you present in the books of the entity is the net realizable value, then there is what we call the write down value. There's a written down value. This is the reason why when we are dealing with impairment of cash generating unit and we have inventory there, we don't touch it because we assume that it is presented on the lower of cost and net realizable value, and any impairment would have been accounted for already. So when we are dealing with impairment and we have inventory in the cash generating unit, we don't touch inventory because the measurements has already taken into consideration impairment. In this vein, basically what this 295 is telling us is that we have to write down the cost or the inventory from 300 to what? 925. So the 5, which is the difference, is supposed to be taken into consideration as what? As an expense or as an impaired, inventories. I'm using the impairment just for understanding sake. In other cases, just an expense written down what? Value. So you present this one as the cost of the inventory, and then the 5 that is the difference will be also an expense in the books of the entity. So this is the treatment when there is the value of your inventory is the net realizable value instead of the costs. All right. Let's look at another important subtopic under IAS 2 inventory. That's going to be the cost formulas. So cost formulas. Or sometimes we can just say cost formula. Right. Well, what are we talking about here? When an entity deals with inventory that are not interchangeable, that means the inventory is produced for a particular customer, then in that case the expenditure incurred on the inventory becomes the cost of the inventory. In other words, when we produce a particular inventory and it can be what? Segregated. If it's produced for a particular project, then we can actually know the expenditure, and that expenditure becomes the cost of the inventory. That means if we are having an inventory that is interchangeable, the first scenario was not interchangeable. That means we cannot, it's for specific customer or a project. That means we can establish the expenditure. But when it is interchangeable, then it comes with a bit of issues when determining the cost. In this vein, we have two approaches or two cost methods that can be used in identifying the cost of the inventory. And then the first one is the FIFO method. And then the second one is the weighted average method. So either you use the FIFO method or weighted average method to account for the inventory, the cost of the inventory, because it is what? It is interchangeable. We cannot readily get an expenditure. For instance, if you buy nails that will be stored in the warehouse of the entity and is not used for a particular project or is not meant for a specific customer, then valuing its cost becomes a problem because you issue some at a point in time, then you go in for another one. So you can use these cost formulas in accounting for it. In this particular tutorial, we are not here to look at how FIFO and LIFO will be calculated. Probably it will be taken under cost accounting. Remember that LIFO is not appropriate here because the standard LIFO is not appropriate here. So we don't use LIFO under the cost formulas because we assume LIFO is having series of what? Limitations. Now, how is this tutorial relevant in practical exam situation? If you have, probably if you have done accounting at the SHS or the early part of your tertiary education, we have a topic we call incomplete records. It is this standard that helps us to know the value of our inventory when there is a limitation in the information on inventory. So this particular tutorial is very useful, in exam situation with practical questions. You will not have it in the full one, but it may be a sub or additional information. For instance, let's assume that a company is expected to produce 100,000 items inventories, and this costs as a dollar or 50,000 in a year. This simply means that per unit cost is going to be $0.50. Okay. Then we were informed that during the year there was a fire outbreak that damaged 25,000 units of the inventories, 25,000 units of the inventories. What is the value of your inventory that you account for, if there is any? So this is a very nice, information that can come under a full topic. So how will you, or what value will you use as your inventory, and what value will you expend if there is any? This is very simple. In the absence of the fire outbreak, in case there was no fire outbreak, you would have produced the 100,000 units, and then the cost of our assets. So in the absence of the fire outbreak, then the cost of our inventory is probably going to be the 50,000. 50,000. Remember, 50,000 is arrived at multiplying the 100 units by the 0.50, and this will give us the 50,000 dollars. Now, there is a fire outbreak, and these are damaged 25 units. So these are damaged 25 units. Then how many units are we left with? Then probably we are left with what? 75,000 units. Simply the 100,000 units less the 25,000 units will give us the 75,000 units. So the 75,000 units was actually what we produced. Remember that we expected to produce 100,000, but because of the fire outbreak, we damaged 25 units. We are left with only 75. How much will this cost us? So this is going to cost us, we multiply by 0.50. This is going to cost us 37,500. So this is going to cost us 37. The value now will be 37,500 because of what? Because of the damage caused by the fire. How much is the damage goods? The 25,000. So we multiply 25,000 by the 0.50, and we are going to get 12,500. 12,500. Remember, if you left this one from this, you will still get the 12,500. Now, per this calculation, what should be the value of your inventory? Now, the value that you present in the books of the entity and for the inventory is going to be the 37,500. And these 12,500 will be used as what? As an expense, or will be expense in the books of the entity or in the P or L account. The reason being that that particular item has damage and therefore has become expenses to the entity. So this is very relevant. This tutorial is very relevant in computing for the value of an inventory in case of such scenarios. So remember, we budgeted for this, or this is what we are supposed to produce, but because of fire outbreak, we produced only 75,000 units. So the cost of the inventory is now 37,500, which was supposed to be what? 50,000. So if you take this one from this, you get a 12,500, which is an expense. So the value you present in the books of the entity is supposed to be the 37,500. So this is very, very, very relevant. Now, you have to disclose the information that are very, very pertinent in the standard. In case you are using the cost model, which one you use, whether the weighted average method. How do you value your inventory? Is it at cost or at net realizable value? They are all important, information they are supposed to disclose to the end users for accounting purposes. Thank you.